Crop condition ratings continue to be historically high and above last year, while winter wheat harvest is just getting started. U.S. corn is rated 78% good to excellent, down 1% from last week, but 10% above last year. Ratings dropped in North and South Dakota as well as Iowa. The first U.S. soybean condition rating came in at 75% good to excellent, which is record high for June. That trend followed in the region except for South Dakota. Nationally, spring wheat is rated 70% good to excellent, which is above last year. However, South Dakota's rating is low. And in winter wheat ratings, both national and regional numbers fell last week. Joining us this week with market analysis is Jim Emter with Van On and Company. And Jim, the markets, grain markets right now, it's all about weather and trade, isn't it?
It really is. When you look to the base, we've got to keep an eye on these rains. It seems like every morning and every afternoon, we're dealing with a circumstance of red, yellow, green, orange on the radar maps. And right now, that's not conducive to a rally. It's really conducive to favoring the bear side of the market. We're looking at opportunities here for crop development. We've got great emergence across much of the nation, and that's presenting problems here for the near term. And when you look to the trade tariff talk, it creates an edge of uncertainty that we need to be attentive to as we work ahead. We really need strong exports, not so much in this market year, but in next, the 18-19 market year. Keep in mind, we run September to September for corn and soybeans. So a lot of what we're looking at is what's to come ahead.
So in that context, let's talk about with weather, unless we get problems during pollination or something like that. Do you think the reversal highs that we put in a couple weeks ago, are those going to hold?
For the near-term resistance, they will. I don't want to sound like an expert to the degree of knowing more than what we do, but off the base here, you've got to look to that as a key resistance point. 1052 off the soybeans and 430 off the corn are going to be stiff resistance points. Assuming we can get above those at some point, the price counts above are not much higher, 440 to 450 for the corn market in new crop. And we look to soybeans 1082. So those are really the areas that if we can get opportunities back towards those areas, producers need to be ready to sell. As for support right now, we're looking at support in corn. The next price count for July corn is 363. We think that is too much for the market to ask right now to take that lower. For soybeans, on the other hand, we're looking at a scenario where 979 and then 941 are the next two price counts. So if we break below 10, that's ultimately where we could end up in soybeans.
The bullish weather story has actually come in the wheat market, produced a nice rally here on Black Sea region being pretty dry?
Yeah, you're looking at the EU, you're looking at the Black Sea region, you're looking at Russia to some degree, that are all dealing with some nuisances in regards to drier trends right now. Does this mean that their production ultimately is going to downtick? It doesn't mean it has to downtick yet. But we're really looking at circumstances where that wheat market has already endured a problem here in the U.S. The winter wheat crop was lower than expected, and we see that reflection and will see that reflection in future USDA reports. But we just don't matter enough. What this can do potentially is bring some export business back to the U.S., because we've really been lagging in our export demand here to this juncture.
That combined with some of these poor yields we've seen so far in Kansas, is that enough to push us through the recent highs that we've had in the winter wheat contracts?
You know, great question. I don't think it's enough based off the U.S. If we can get greater problems, you got to remember, wheat's a crop that we view has 9 lives. It's one of those that you can kill and it comes back and kill and comes back. We see pretty stiff resistance here up towards the highs yet, so I think we need to have some discipline, especially in the Chicago, Kansas City wheat for those winter wheat producers. You've got great carries built into these markets, so you need to be attentive to those opportunities. If spring wheat can get back up to 640 to 650, we view that's an area some marketing should take place, but then hold some discipline to see if we can't get up to that 685 level, which would be the next price count.
And finally, the cattle market looks like the futures have bottomed. Cash, we're not sure yet, but do you think that we're going to be able to build on this?
Yeah, you know, the packer margins are extremely strong right now, and we look for that to be kind of the encouraging undertone that eventually drives this market to mid to late summer into fall. We really look for this market to have had the bottoms at this August level of $98, and we really think this market can stand up here as we work ahead, just due to the fact that the cattle on feed reports, we've had 2 in a row that have at least been a little bit more friendly. You know, getting slaughtered by the placements have been really a negative feature here, but we look for that cattle market to have bottomed and working towards these 109 August price counts and potentially all the way up to a 118 December price count as we work ahead.
Thanks so much, Jim Emter, joining us with Van On and Company. And for extended conversation, you can go to agweek.com.